Welcome back to Talk Property to Me. My name is Brad East, and today I have Luke Morrison here from Bell Property in Newcastle. And what we're going to be talking about today is essentially how, waiting 2 or 3 years until the conditions are better, you've saved more deposit, or whatever that is, can actually cost you, I think we worked out around $900,000, let's say over a 4-year period after 30 years. So basically how that works in summary is compounding growth. So I guess we'll start with a bit of an example here. We'll start with, I guess, one that's probably a little bit more ambitious, which is a 10% growth. I started that one out. But so 10% growth after 1 year, obviously it goes up 50,000.
Yeah.
But then
Working off a bottom number of 500,000.
Correct. So we start at 500, 10% a year, your house is then worth 550. Now, that doesn't seem too impressive, but then that 550 grows by another 10%, takes you, all of a sudden your growth is now $105,000 in 2 years, and that just keeps going. It's when it hits around that 10-year mark that it really starts to compound and grow substantially. So, sorry, go.
And even realistically, we say 55 grand isn't a lot, but in the scheme of things, how many people can save 55 grand in 12 months?
No one.
No one.
No one can.
Yeah.
And when we look at, I guess another way to look at it as well is a lot of people hate paying lender's mortgage insurance.
Yeah.
We
hear it all the time.
Yeah. Let's say, as an example, we'll work backwards. I'm going a little bit off script here because of LMI, but let's say you were purchasing at 500,000, you had a 10% deposit. Off the top of my head, lender's mortgage insurance, would be around 12 grand. Let's call it 12 grand for the sake of this podcast today. Someone can prove me wrong if they want. But that $12,000 is a cost of purchase. You've got your stamp duty, you've got all those things. At 10% growth, which is, again, it's up there, you're going to make that back in the first year.
Yeah, 100%. We're going to make it up.
On your sheet, which is 7%, that's 35 grand.
Yeah.
In the first year on the same purchase price.
So you're still 20K in front or 23.
You're still in front.
Massively.
In a year.
Yep.
Now, you know as well as I know, Luke, that prices are never going to be this cheap again.
Yeah, correct.
The prices are going up. Like it or not, if you're waiting for something to improve, it's likely that's not going to happen.
I guess my biggest thing that I come across at the moment is there's talk if inflation doesn't come down, we're going to get an increase next month, or, some people are talking about how we mightn't get a decrease till next year. It doesn't matter.
Yep.
You're marrying the house, the rates that you're on, you're dating is how I like to explain it. You're not married to it. You can always change. You can always, waiting for the right interest rate is going to cost you money in the long term. And I guess just teaching people through that process, which is a lot coming back from conversations that I've had with you as well. There's no better time to buy than yesterday.
Yeah, well, according to this sheet, 30 years ago.
Yeah, literally would have been good.
I was 8. I wasn't able to, but...
Yeah, I hadn't even been conceived yet. I was probably still eggs in my...
You weren't even a thought. But, I guess what I'm trying to stress in this is you're going to make back any of these costs within the first year or two in this current market. And even if we do have one shit year in between or a couple of shit years in between, that growth, that compounding growth is still there. You're not going to strip, 30, 40% out of it. We've never seen that. I think GFC, we saw quite a drop, but then straight after GFC, it rebounded straight above those prices again quite quickly. Besides, I think there was Perth and a couple other smaller markets that didn't. But, we look at that growth now. As a bit of an example, I'm going to get the calculator out here because I'm not that smart. But if we waited 3 years, so basically we're cashing out at 27 years instead of 30 years here. So at 27 years, that $500,000 property that you purchased 27 years ago is now worth $6.5 million, $6,554,997 to be exact. So that's quite a good increase. But because of that compounding growth, 3 years later, it's actually worth about 8.
Yep.
So
exactly right. It's compiling. It's like interest rates, right?
Correct. You know, a 10% growth on something that is 6.5 million compared to something that's 500,000 is obviously a lot better or a lot bigger. So that 3 or 4 year sort of gap there, let's work that out. That is, well, I don't need to because it's, so that's about 2 mil.
Yeah.
Bit over 2 mil.
And I guess the biggest thing with that as well, like when we're speaking to people, and I'm not sure if you have the same conversations when they're talking about upsizing on the market, it's no good. Like if you're in the market to upsize due to, you know, similar situations to what, you know, we're both in, another kid on the way or kid just got here, upsizing into that next size property, it's going to cost you more. Yep. Okay. You're going to pay more costs, et cetera, but it's going to be worth more.
Yep.
And it's going to grow more. So in the long term, you're actually going to be better off, much better off.
Yeah, there's people, I guess, whinging and complaining about boomers at the moment. But this is how boomers have made their money.
Exactly.
They bought property 30 years ago.
Sat on it.
They've sat on it. Some of them have done it well. Like majority of people that have made their wealth is through owner-occupied properties.
Yep.
It's not, you know, not a huge amount of people have more than even one investment property.
Yep.
So they haven't gone nuts and haven't gone and bought these huge portfolios. They've literally bought a house as early as they could and sat on it.
Yeah.
And then at retirement, most of them downsize.
Yeah.
So you don't need your 5-bedder house anymore. You downsize that, which, you know, let's just talk as Newcastle as an example. If you bought something in Bar Beach, 5-bedder in Bar Beach, what's that's worth? About 3.5 mil or something?
Yeah, depending on the condition, it could be worth, you know, 5, who knows?
Yep, 5 mil. So let's say you sell that $5 million owner-occupied, tax-free.
Yeah.
You know, you're not paying any capital gains on that. Then you go buy an apartment over at Honeysuckle or similar for, 1.2, you know.
Plenty of cash in the bank there.
You got a bit of retirement funds.
Even like a good example, like Adamstown Heights, we just sold one in there, and I'm just going to look it up now. But obviously, a real in-demand property in a great suburb with great growth, really good school zonings, et cetera, et cetera. These guys bought it in 1995 for $130,000, I think. $150,000. It's just sold for $1,050,000. So no renovations.
They did all right.
Yeah.
Same asset. So no renos at all.
20, yeah, like it's nothing.
Mental.
Yeah.
It's almost, what's that, 30 years?
28.
So back to the interest rates. You mentioned the interest rates, and we see it a lot as well. RBA are saying, like, look, let's be clear. I don't think they're going to raise it again.
No way.
What they're doing at the moment is they're putting that fear into the media. That media then passes it through to the consumers. Consumers shit the bed and go, "Oh, I'm not going to buy now." Because it's to calm, I guess, the general population. The easiest way to control population is through media.
Yeah,
and that's what they're doing.
Yeah,
whether you like it or not. And people do follow it and people do believe it. I don't think that they're going to increase those rates anymore. I think they're doing a little bit of scare tactics to sort of see if that works instead of having to actually raise them. Tell people you're going to raise it and it works. Like, you know, count to 3 to your kids.
Yeah, literally.
It's I think with my kids I have to count to about 400.
Yeah,
but
I'm at 3,000 now with Guy.
But basically, I don't think that's going to happen. I think 3 of the big 4 banks are tipping 5 rate reductions next year, and I think only ANZ out of those big 4 are tipping 3.
Yeah.
So that's what, 1.25% odd reduction, which is great. But what I see at the moment, which is an instant win for people, is refinance your home loan now.
Yeah.
Go for a cheap rate now. Most banks have got people sitting on, you know, 0.5% higher than they could if they refinance somewhere else. That's 2 rate reductions. You've got people sitting here waiting for the RBA to do it. Yeah. Do it yourself.
Yeah, 100%. And I mean, it's just probably because a lot of this information doesn't get out there. Like a lot of people, like your mum and dad investors and your mum and dad homeowners that have been with Newcastle Perm for 30 years. Oh, we wouldn't go anywhere else. It's costing you money. Like, why wouldn't you open up your eyes? Like when you go to, you know, put the electricity on your house, do you just go, oh, Energy Australia will do, or do you shop around?
Well, that's right. You're getting ripped off left, right and centre. Banks make their money off removing their discounts. And I've said this in other episodes, but let's say you have a variable rate of 8.8, so that's their standard variable. The rate that you're getting at, say, let's 6.1, is discounted from that. So they're not technically raising their interest rates. What they're doing is lowering their discount when they increase it.
Yeah.
So they can get away with it. And that's what they do over a slow period. And because they're not technically increasing your interest rate, they're removing their discount, then
they're still making
they
money.
just throw it on a statement and you don't really notice.
Yeah.
You know, here's my challenge for the listeners and today. Check your bank statements. See what it was originally or even 12 months ago versus now. And if it's changed, go back to them.
Yeah.
The quickest way to get a fast discount on your current home loan is call them and tell them you're refinancing. Ask them for a discharge authority. Literally ring them and say, I'm moving to XYZ lender. Can I please have a discharge authority? Yeah. What that does is it puts you through to their retention team and then they will start talking price with you.
Yeah.
You do it before that process and they just go, oh, no.
No, thanks.
Yeah. But look, saying that, some banks don't give a shit either. They'll go, hey, and they'll probably send you the discharge. But if they do send you the discharge, it doesn't mean you have to sign the bloody thing.
No.
You say, oh, sorry, I changed my mind.
Yeah.
Or sign the bloody thing and refinance.
Yeah.
Call their bluff. So that's, as I said, 0.5%, that's 2 rate reductions. Plus 5 next year. Take the matters into your own hand.
And then that's back to the LMI, like obviously just paying it back to the, say for example, you're buying something at 500,000, which is quite hard in our Newcastle and surrounding markets, the $12,000. So even if you worked it off of $1 million, has just doubled. Does it go to 24,000?
Yeah, it does. It'd be less even if you called it 30.
Yeah,
30,000.
So if you call it say 30,000 at $1 million, right? 7% is pretty fair in and around that sort of 2287 market that I sort of do a lot in. If you can get obviously a bank reduction by 0.5% and then you get 5 next year. That 30 grand you've just spent, you've just made it up in 12 months and about 150,000.
Easily. So I guess, the whole purpose of this episode was literally just to say that if there's a cost that's holding you back, such as LMI or stamp duty or whatever that is, you're going to make that back in the first couple of years.
Yep.
Just pull the trigger on it, get into the market. You'll soon forget about that cost.
You'll forget about it. And one of the things that I always say to whether it's a vendor, whether it's a purchaser, or any deal, time heals all deals.
Yeah.
So no matter what, the most important thing is just getting into the market or getting into the property where it's more comfortable for your family or downsizing, whatever it may be. Time heals all deals.
Oh, 100%. And
that's a proof.
Yeah, and just to summarise that again, so, if you waited those 4 years, in this example, 4 years, the house would be worth... the house is worth, say, 6.55, and then that 4 years later, it's actually worth 8.7. That's at 10%. If you did it off the same time frame at 7%, it's about $900,000 difference instead of 2. But that's 7%. That's pretty conservative. I think that's actually achievable.
Yeah.
10% was just for me to show you, you might have 1 year that's a
12%.
12, we might have a 6.
Which that might happen next year.
Yep.
So there's no better time to buy than right now to get into the market at where they're talking about doom and gloom and, interest rates could go up next month.
What do you think is going to happen when these rates start going down?
Well, I've seen it. My career started just before COVID or during COVID rather, and obviously prices were just like name your price and you get it there sort of thing. And what do you think is going to happen after 5 rate reduction and there's no bird flu going around? Like,
People hate having, sounds stupid, but people hate having disposable income sitting in their accounts. When they look at it and they're not spending it all, then they go, oh, maybe we could upgrade the car, or maybe we could upgrade the house, upsize. When people have got the disposable income, they want to spend it.
Yeah.
And all of a sudden, I think I worked out, on a $800,000 mortgage, they're going to have an extra $500-$600 a month in their pocket by the end of next year. That's near half a mortgage payment.
It's only my fruit bill at home.
That's a lot of money back in people's pockets. So people are going to want to spend that.
Yeah, 100%.
So if you think that you're waiting for next year for better interest rates, yes, your borrowing capacity may go up slightly.
Price is going to go up quicker than what your borrowing capacity will.
Correct. You're not going to be able to keep up with that. And you look at some of the factors as to why they're going to keep going up. Immigration levels, are at all-time high. You've got the housing approvals, building approvals, all-time lows.
Yep.
You know, they're not keeping up with each other.
So, yeah, and that's where, you know, that 10% number could definitely come in, especially in your high demand areas, like anything that's sort of close to a lake or the beach or whatever. That's where it's definitely going to start pushing it more and more up. Like your in demand suburbs obviously see it no matter what the market's doing. But
and this is, I guess, a good example as well of that set and forget mentality with buying property.
Yep. 100%.
Buy it, throw a tenant in it, forget about it for 30 years. Literally, because buying and selling and trying to time these markets, you're going to miss out on a lot of this growth. But it also outlines that the difference between the 10% and the 7% growth, that, you know, that was a bit over $1 million difference. That shows the importance of picking an area or a suburb and an asset class that's going to perform better than others.
Yeah, exactly right. And even like first home buyers that come through, we had an old fella help his great-grandson buy a house in Fletcher off us a little while ago, and they use like all their first home buyer schemes with, you know, the government helping out with a certain percentage of it and all that sort of stuff. And he said to me, I've been telling these kids for years that there's no better time than now to buy, and the best time to buy was yesterday. And if you think you're getting on the boat tomorrow, you've missed it because it went yesterday.
Yep, 100%. Get on today's boat. That's it for today. Quick episode just to run through that. I guess really stress the importance of that compounding growth on a bigger scale. You know, compounding growth in, you know, 5 years isn't that impressive, but when you look at it at 30 years, it definitely is. It is.
Yeah.
We want to be those next generation of boomer style rich
100%.
people at retirement. And to do that, get into property. It's
100%.
as simple as that. Your Bitcoins and all that shit isn't going to compound like this. In my opinion, anyway.
Totally agree. Any questions about real estate, reach out. And if you've got any questions regarding finances, make sure you reach out to Brad.
Awesome. Thanks, guys. We'll catch you on the next one.